Okay, hello and welcome to episode 1 of my technical bootcamp. This is going to be a year-long series where I'm going to break down absolutely everything you need to know about technical analysis and charts so that you can master that realm of trading. There are going to be 12 classes per season spanning over 3 seasons. We are beginning with season 1, where we will look at foundational layers of all of the different concepts that I trade. We're going to be talking through everything and we'll go deeper level and then go to advanced approaches throughout season 2 and 3. These classes will be dropped weekly, and this will be probably the most valuable bit of trading education you've seen if you follow along with each of these episodes. It's not going to be fun, it's not going to be hyped up, there's no retention editing, but if you're here to solidly learn, then this is the place for you. Now, before we begin, a simple disclaimer. All content inside of the bootcamp is for educational purposes only. It does not constitute financial advice. Trading is risky. You know this. You should trade safe, study deeply before you risk real money, and trade in simulations to master the approaches that you learn. With that said, let's get into today's class, which is, as episode 1, a focus on price action. I'm going to give you an introduction to candlestick trading and price action trading as a whole. I'm going to explain to you why price action beats any other form of analysis, and I'm going to show you the best concepts to use and which ones you should ignore. So with that said, let's jump over to the charts and get to work. All right, so first, what do we mean when we say price action? Well, when we say price action, we simply refer to raw price, okay? We are tracking the raw price of the market, meaning we are looking at the candlesticks, how they've printed, the ups and downs in here, and all of the information these give us. And we are not using any indicators. We are not going to use any external factors. We focus purely on what the price is telling us. Now, a lot of people opt to use indicators, and I'm going to tell you why I don't like this and why I prefer to focus on raw market price. With an indicator like a stochastic or pretty much any other indicator, the information these give you, while you may think they're telling you important information, is only telling you things that the market price has already printed. So all of this is lagging. It's not giving us any insight into the future. It is simply giving us information based off of the candles that have already been printed. So 1, we are basically looking at information that is not telling us anything new. And 2, if we are going to focus on real-time happenings to determine where the market's likely to go next, in my opinion, it makes a lot more sense to look at the raw, real market price, the movements that price itself has made, rather than trying to overlay some random lines, some lagging information, and trying to use that to determine our decisions. So indicators are out of the question. Now, we may introduce a couple throughout the series, but these are things like session indicators, which simply mark out different times of day to show you the important times to be trading at. This is not an indicator in the sense that it's giving us any information. It just simplifies and automates a part of the process for us. But we'll get into that a little bit later. So with that said then, price action is all about reading the story of the market, or at least price action in the sense that I view and trade it. The market is endlessly telling us a story. Each of these candles that prints, and we'll talk about candles in a bit more depth in a moment, candle for now, or one of these blocks. Each one of these that prints is giving us some information as to whether buyers or sellers are in control at that moment in time. Whether buyers or sellers are in control is crucially important because this tells us whether the market will be going up or going down. And if we want to make money in this market, we need to know what is likely to take place so that we can profit on the up moves by buying the market and profit on the down moves by selling into the market. So when we're looking at raw price action then, there are a few concepts that we want to, number 1, focus on, number 2, avoid. Because in my opinion, there is good and there is bad price action analysis. And I want to preface this entire series by saying this is to some degree subjective. I'm sharing my opinions and what's helped me and the people that I've taught to find success. Okay? You can disagree with what I say, that is fine. You can trade concepts different to what I trade, that is also fine. But this is my view of the market, and that's what I'm going to be teaching you here. So, as I've said, when I'm doing my price action analysis, when I'm reading the candlesticks, when I'm reading the movements, the highs, the lows that the market has printed, I am trying to develop a story or a narrative from the market. I'm reading into what each of the candles and what the larger candles in context are telling me about buying and selling pressure and control from buyers or sellers, because this is ultimately what helps us to determine which way the market's going to go. So I am not a fan of patterns. For example, some people trade triangle patterns where you draw some lines on a chart and then you wait for a break and retest and sell or buy accordingly. I don't like patterns like this because, again, they are not tied into narrative or story or explaining anything about what price is doing. We want to essentially detach from the idea of pattern trading and instead focus on narrative creation, okay? So we are really looking to build stories from the market using the information that it's giving us. Now, that pretty much eliminates immediately chart patterns, they're out the question, and other things like support and resistance and trend lines, which to a degree are just patterns in their own right, okay? So to show you what those are real quick and why I avoid them, a support or resistance level is simply a line that we draw on the chart based on areas the market's reacted from. So for this example, you can see we had a tap here, and then we broke and we tapped the market at these levels and here again. The idea with this support and resistance is if the market is above the support and resistance, we look to buy retests of it. If the market is below the support or resistance level, we look to sell retests of it. This is an okay way to trade if this is how you want to trade. And this is going to come under the label of price action trading. But for me, it's again, just another pattern. This doesn't actually tell us anything. If you think about what you've done here, you haven't built any story. You've drawn a line on a chart and now you're saying, if it taps above, I'll buy. If it taps below, I'll sell. Now, why does this not work so well in reality? Why are there so many people trading with this concept and completely failing to make it work? Well, pretty much for the same reason that most people trade most concepts and fail to make them work. That is because it makes no sense. They are not making sense of what's happening in the market by drawing these lines. They're basically just setting up some arbitrary level that will buy or sell with pretty much no reason other than, well, because it tapped imaginary line. If we think about this line does not actually exist in the market. It is literally something you've drawn on. If we delete this line, then there is no more support or resistance. Sure, the market showed reaction to this level a few times, but really it isn't there anywhere outside of your imagination. So again, you may like support and resistance. If you do, keep trading it, stop watching my videos, and I hope you reach success. But if you've been struggling to win with it, that is one of the reasons why. It gives us no information to the broader story or the context of the market. Therefore, I don't think it is a good price action concept to trade. So we will not be trading support and resistance. We will also not be trading chart patterns. So that's anything from triangle patterns, wedges, head and shoulders patterns, all of these different things that you may have learned previously. I do not see these as good price action trading, okay? They come under the label price action because you are just using raw price, but in my opinion, they are pretty much useless. Now, the final one that we will not be using in this, right, is going to be trend lines, okay? So a trend line is much like a support or resistance level. It is basically an ascending trend line would look like this. We connect the dots of multiple lows, and then the idea is if the market stays above this level, the trend is up. And for a descending trend line, we would connect the dots of multiple highs. And the idea would then be if the market stays beneath this level, then the market is trending down. There's a problem with this that will become very clear when we get into the market structure education, and that is that not only do these not actually show the market structure, and they don't actually tell you what the trend is, they can also be a very big trap. Because if you believe that a trend line tells you the trend direction, you're going to take a lot of trades against the reality of the market. The truth is that the market price, the raw price that we look at inside of our price action trading, can be up while a trend line is down. And you trusting the trend line over the real market price is going to have you in situations where you are selling a market that is going to continue to ascend against you. The same can be true for when a trend line breaks. A core way of trading these trend lines is if the trend line breaks and closes, you look to sell. But as you can see in this example, it broke, it closed, and then it just bought again. From the market structure view that I use, this is completely obvious because the market continued making highs and lows that lead us to believe the market should keep going up. So trend lines, again, they are pattern-based, they are not contextual, they do not help us build narratives, and they also fall us more than support or resistance because they give us false signals as to determine the direction of a trend. So for me, I focus on narrative creation. The lessons you learn in this bootcamp will focus on narrative creation. We will not be using pattern-based analysis, pattern-based price action concepts like support and resistance, chart patterns, and trend lines. We are learning to read the story the market tells us, not stick patterns on a chart and hope that it works out. So with that said, that's an introduction to price action. In regards to the concept, I will not be trading in this bootcamp. If you trade these, again, continue to do so if you think they are good. But for me, these are no good. These are not going to help us to build our narratives. These are not going to help us to read the story of the market. Therefore, they are chopped off my list. Now, before I talk about the concept I do trade, I want to dig into these candlesticks and show you what an individual candlestick actually shows and how we read these to determine information from the market, because this is a very important point leading into pretty much everything else we do. So let's do that now. So the charts that we use for our price action trading are called candlestick charts, Japanese candlestick charts. What they are showing is a series of individual candles, and each candle, so each one of these little gray or blue sticks, for you they might be green or red, can be any color you want, is showing price movement within a specified time frame. Now here we're looking at the 1 hour time frame, which therefore means each of these candles is showing price movement within 1 hour, okay? Now, to talk you through the anatomy of these candles, and even if you think you understand candles, you should watch this, because we're gonna go deep into why the candles are doing what they're doing and how we read them, which is the more important part. Each of the candles looks like this, okay? This is what we would call a bullish candle, the blue one, and the gray one is a bearish candle. Now, a candle is made up of basically two parts. We have a candle body, and then we have candle wicks. The body is the large, solid, colored part, and the wicks are the little sticks that come off either end. The candle body shows confirmed price movement within a given time frame. So if we liken these to the 1 hour chart, each candle would be 1 hour of price movement. A bullish candle will have an open price lower than the close price. This is the price the market was at when the hour began. And then it will have a close price, which for a bullish example will be higher than the open price. And this is where price was sitting when the hour closed. As soon as the hour closes, another hour will begin, and we will have an open price on the next candle immediately. If the market then moves down, we get a close price which is lower, and the candle body for that hour would actually show us bearish price action, confirmed bearish price action within that given time frame. Okay, so the candle body is simply how much the market moved within a specified period of time. For a 15-minute chart, that's how much the market moved in 15 minutes. For a 4-hour chart, it's how much it moved in 4 hours. It's nice and simple. Now the wick, then, what does this show? Well, wicks show us rejected price action within a given time frame. What this means is this is a price point the market pushed to at some point within that specified time period, in this case an hourly, so within 1 hour, but did not close at. So simply, the wick up here just shows us that the market at one point had a candle body that looked like this. The market was pushing higher, but then before the hour closed, it ended up coming back down, which is why we say the price up here was rejected, because the market wasn't able to close at those levels. It also means at some point, the market actually came down here. So the lower wick indicates to us that this market was, for some period of time, actually bearish within this hour, okay? We opened here and we traded lower than the open price, but we pushed all the way up, closed up here for the end of the hour. So these bodies and these wicks give us a lot of information that we can use to our advantage, and they're actually pretty much staple in helping us build our narratives, because what a candlestick shows is basically buyer psychology and buyer action and seller action within a specified time period, all right? And we get a lot of information from these bodies and wicks. So we're gonna talk about this in considerable depth soon in a class on momentum. But for now, we will discuss the general basics of what a candlestick can give us in terms of information. So if we focus in on the bearish candle, then what we're gonna do is consider the market opened here at the beginning of the hour, and then it's moved all the way down to this level and closed here at the end of the hour. The additional attempt to go higher and the additional attempt to go lower can provide us some information. In a candle like this, where it's exceptionally bearish, moving from here down to here within this specified time period, we wouldn't worry too much about the lower wick because it's not too big, and we definitely have a notable amount of seller control within this time period. The way we want to think about candlesticks is a battle between buyers and sellers, a game of tug of war, and we can see who's in control when the candle closes by determining how large and strong the candle bodies are versus the wicks. So for an example like this, we would be interested in basically seeing that the wick at the top was rejected, showing buyers were pushed out, they were rejected from this market, they weren't able to push this market higher, okay? Then the close all the way down here indicates that sellers were clearly in control over the buyers. There's more selling than buying taking place. Therefore, the market has managed to move lower because supply is increasing, demand is decreasing. The market then gets down to this level, and although we do have some rejected lower prices, the candle body is so large, even closing here, that we would indicate this is definitely a bearish candle, okay? So from this, we would generally mostly be interested in continuing to look in the downward direction for future trades. We would expect this market is one that is likely to move lower. Now, of course, bigger picture context matters, as you will learn throughout this bootcamp. We don't really base trades just off one individual candle, but they can give us significant information that we use inside of a larger context, okay? So to explain how it can give us different information, let's take a look at an example. If we just pull this over here, give it its own space. Let's take a look at an example where this would give us more of a deeper insight, essentially, because this is quite a normal bearish candle. It's just going to tell us, okay, the market's selling. It's probably going to continue selling. But if we were to have a candle like this, for example, which has opened at this price level, it has pushed all the way down here, but then it has closed at this price level, we could say, well, this is a bearish candle because the market closed bearish. But we have to think about what this rejected price is telling us. If we look at this, as we've just said, as a battle between buyers and sellers, we see that sellers attempted to take the market all the way down here. They came in with force. However, at some point before the hour ended, buyers have pushed the market all the way back up towards the open price. So this candle actually tells us, although it's a bearish candle in reality, it tells us something very interesting. And that is that buyers have kicked in at mass force somewhere down here and actually reversed pretty much all of the price action that sellers achieved throughout this given hour. Well, this could actually be a reversal indication. This could give us some insight, although the candle closed bearish, that maybe the next candle, or at least very soon, could actually start leading us to the upside. Because we've obviously seen every time we get down here, or at least up to this point, buyers are kicking in such force that they're basically taking over every bit of movement that sellers achieved in that time span. This could basically indicate the turning point of the market where we may lead into higher prices and stop moving in a bearish fashion. So that's just an example as to how we can pull information from candlesticks. Instead of just looking at static patterns on these charts, you can read into pretty much exactly what's going down by just reading the candles in this light. So, as I've said, we will get deeper into candlestick anatomy and how this momentum works on a broader scale when we get into the momentum class. But for now, I'm going to leave it at that. You now understand what candlesticks are, and hopefully this explanation has showed you how I start to do this in context. You understand I'm trying to read stories from the market, and this is how we do it from an individual candle basis. So now let's talk about the concepts that I do like and will be teaching you throughout this bootcamp. Okay, so when it comes to the price action trading that I do, we've already discussed that I don't like to trade with the basic retail concepts, should we call them, which are essentially like support and resistance and trend lines and things like that. I prefer to operate with something I call logic-based concepts, and that's simply because these make the most logical sense to me and they help to build the story in the best way. To list these, we have market structure, we have supply and demand. Now this one is a really big one. When we get into the supply and demand class, that will change the game as to how you see the markets. We have market efficiency, we have momentum, and we have liquidity. Now, each of these concepts, doesn't matter if you don't understand them yet, and if you believe you do, you're probably going to learn more about them in this bootcamp than you already know now. Each of these concepts serves a role, serves a purpose in helping us to determine our overall story and narrative for the market, which is what we use to then take good trades. So structure refers to the direction the market is trading in, and we use high and low structure. So we simply mark the lows and the highs in the market to determine whether this is going up or if it's going down. And this is a very simplistic, but there's a lot to it, does get pretty elaborate, way for us to actually analyze the direction of the market. We're gonna get into this, I believe, in the next class. Supply and demand refers to areas where notable buying and selling is entering the market. We use supply and demand to determine where to get into trades and to determine high probability areas to, number one, target, and number two, execute positions. So a demand zone would look like this. Of course, this is very simplistic right now, and I don't expect you to understand it. But so far, from this market, we would identify the high-low structure and realize this market is heading to the upside, and we would use supply and demand to actually find the execution point, which would be the zone just here. So we'd be looking at buying from this level to take this market higher as it has. The next concept is market efficiency. This is basically the theory that markets like to come back and fill open price ranges, generally to fill into new orders that are still waiting to be retested. Market efficiency refers to something you may know as imbalances, or fair value gaps is another name that someone's made for them, but they're traded in a different way as fair value gaps. So market efficiency, or an inefficiency in the market, we'll keep it at the moment, is simply an open price range between a demand zone or supply zone and where price is right now that hasn't been filled yet. So when we saw this rally from this area of demand that I marked, this concept basically tells us we will not buy the market anywhere above this demand. We must wait for the imbalance or inefficiency, which by the way is this price area here, to be filled before we can execute any trades. Then when it comes to momentum, we simply look at the strength and size and speed of the candles on their own, and also from a multi-candle momentum perspective to see where momentum is strong, where it's slowing down, and get an idea as to whether we believe that buyers are still the right way to be going in this market. So to show you what I mean there, this movement up, very fast, very quick. The pullback down, slower, weaker. And then as we hit this, we start to get these strong bullish candles again, okay? So by identifying speed and size of candles, we determine whether we want to be moving with the market. And then liquidity refers to areas in the market where orders will be situated. This one is rather elaborate, so I'm gonna get into this when we get there. But those are the concepts that I use, and each one of them, as I've said, serves a purpose in helping us to determine which way the market is likely to go by helping us build narratives and stories around them, as opposed to just building, patterns on static charts and praying that something fits. These are the concepts that we're going to be digging deep into throughout this bootcamp. And through season 1, every single one of these will be broken down for you, and you'll understand pretty much everything you would need to know about these before we get into the deeper level stuff in seasons 2 and 3. This bootcamp is going to teach you these concepts most likely better than any paid program that you've enrolled in when it comes to the technical elements of trading. I'm not holding anything back. I'm going to give you everything you need to know about all of these approaches. So with that said, that is episode 1. This was more of an introductory class, teaching you about the way that I trade from a simplified view, teaching you about price action and what we focus on here and how I view the market. And next episode, we'll be getting into the core concept behind understanding markets, and that is market structure. So with that said, that's all for this class. I'll see you in the next one.